Hello, everyone, and welcome to the Inside ETFs weekly webinar. Engaging a New Generation of Investors, a conversation with Donna, Nairi, founder and CEO, ICONICBETA. My name is Saveda Nerona, and I'm the Director of Conference Content here at Inside ETFs, and your host for today's webinar. How do you bring a new generation of investors into the markets? How do you inform millennials that thinking long-term investing is important? In today's webinar, we are joined by a new thought leader on this topic to help answer those questions and discuss her uncommon approach of combining music, disruption, and ETFs at her goals for 2018. Donna is the founder and CEO of ICONICBETA, the indie index provider that made headlines by working with music and entertainment legend Quincy Jones on the Quincy 100 Index. Donna's mission is to humanize the public equity markets by injecting the intimate knowledge of industry icons and a human story into the veins of Wall Street. Donna is a former multi-asset structure at RBC Securities and Sempra Energy Trading in Hong Kong, London, and New York. Donna's mission is to humanize the public equity markets and is passionate towards helping solve financial illiteracy issues around the world. But before we get to Donna, we have a special treat. Yasmin Daya, Executive Director, is the head of America's beta specialist team at JP Morgan Asset Management. In this role, Yasmin works closely with client advisors to position their expanding suite of beta strategy solutions with clients, including strategic beta, alternative beta, and market cap weighted strategies. Prior to this role, Yasmin worked as part of the firm's ETF product development team, where she focused on developing the overall ETF product strategy and launching new ETFs across all assets. Yasmin is going to join us for our special Fund of the Week segment, where we consider one fund that we find especially interesting or important for investors in today's market. Yasmin, I'm going to hand over the controls to you, and we'll give you 5 minutes to preview your fund for our audience.
Thank you very much. I want to spend the next 5 minutes talking about an exciting area of innovation happening in the ETF landscape, which is access to low-cost, transparent alternatives. ETFs have been profound for democratizing access to core investment exposures, and what I want to discuss today is the next frontier of that, the democratization of hedge fund investing. So let's start with the problem statement that investors face today. Given the current market context, investors should be looking for diversifying return sources in their portfolio. If you think about it, in the last 9 years, investors haven't really needed a hedge strategy in their portfolio. Since 2009, U.S. equity markets have delivered around 15.5% on average annually. But the question is, what does that look like in the future? In our long-term capital markets assumptions at JP Morgan, we have U.S. equity returns around 6.5%. That is a difference that investors need to reconcile. 15.5% historically with 6.5% on a long-term forward-looking basis. And then, of course, there's the structural challenge that faces fixed income, which is that after a 30-year bull market, there's the question as to what role fixed income will play in your portfolio. What does this mean for investors? It means, given the market context, it may be time to consider alternatives. So what role can hedge fund strategies play in solving this challenge for investors? This graph shows monthly returns of a global hedge fund index in both up and down markets for stocks and bonds. Hedge funds have historically provided an asymmetric return profile, capturing more market upside than downside. In a rising market like we've seen over the last 9 years, they have lagged. But this asymmetric profile is very powerful over a full market cycle. It proves why there is a benefit to adding a hedge fund strategy into a portfolio, particularly if you believe in the slide before. But there is a challenge, and it's one of cost. Traditional hedge funds typically charge a management fee and an incentive fee. This graph shows the power that fees can have on an investor's outcome in a hedge fund strategy. The blue line is MSCI World. The green line is a hedge fund net of fee index. It does not look very attractive. But if you add back management fee, you get that dotted line. It totally changes the story. Here is the problem. The benefit of hedge fund investing is accruing to the manager, not the investor, and that gap is represented by the gray and green lines. Fees can meaningfully reduce the return capture for investors. Said differently, if you lower the cost of the exposure, you can transfer back that benefit to the end investor. That is the problem to solve. How can I deliver that same diversifying return stream at a lower cost structure? So let's talk about the solution. It's called alternative beta, which is about accessing the systematic return sources associated with alternatives. While those words may seem like a completely foreign concept, it is actually something that all of you are very familiar with. Let's put this into context. On the left-hand side, think about traditional investments, equity markets. We take it as a given that you would benchmark an active equity manager against an index. Said differently, we see a distinction between alpha and beta in equities, the difference between idiosyncratic manager skill and the systematic capture of an asset class. Alternative beta, the systematic capture of alternatives, is just an extension of that same concept to the right-hand side of the page, to alternatives. If you look at alternatives, people traditionally look at the returns produced by a manager and they attribute all of that to alpha, idiosyncratic manager skill. In fact, though, there is a portion of that return stream that can be captured systematically and that can be accessed at a lower cost and with more liquidity. Another way of saying that, we should not benchmark an alternative manager versus nothing. We should benchmark an alternative manager versus systematic capture. What is powerful for clients is that green part on the right-hand side of that graph is now investable. You can now actually access the systematic capture of alternatives called alternative beta. What this means is it's solving the cost problem that exists for hedge fund investing for investors. And that is exactly what we're doing at JP Morgan with our suite of alternative ETFs. We've actually been investing in alternative beta since 2009. We launched our first ETF last year, JPHF. In JPHF, as you can see, we cover three core strategies: equity long short, event-driven, and a macro managed future strategy. We offer the whole solution, JPHF, as well as the individual sleeves on a standalone basis. So I want to end with where I began. Investors should consider alternatives given the market context. Hedge funds have historically been a good diversifier, but have come with a very high cost. Investors can now access the systematic capture of hedge fund strategies called alternative beta. What is exciting is that this is now coming to ETFs. We've been a pioneer in the space, managing money since 2009, and we're now bringing that innovation to ETFs with funds like JPHF as well as the standalone sleeves. If you have any questions or want any more information, please contact your JP Morgan representative or visit our website. Thank you for the time.
Thank you, Yasmin. Again, to find out more about Yasmin's fund, I encourage you to visit their website at jpmorgan.com. Now let's turn to the second part of our webinar, Engaging a New Generation of Investors, a conversation with Donna Nairi, founder and CEO, ICONICBETA. As a participant of this webinar, don't forget to send in your questions using the Q&A toggle on the bottom of your screen. I'll ask them throughout our conversation. Donna, thank you for joining us today.
Thank you.
Why don't we start off with, why don't you tell us a bit about yourself and how you formed ICONICBETA?
Sure. So I'm a former structurer from RBS Securities. You mentioned RBC. Everyone always mistook RBS with RBC, but the Royal Bank of Scotland. So I worked in the institutional structuring team, and we worked on a number of complex products for mainly financial institutions, and some of those included indexes. And it kind of got me thinking about indexes, and back then ETFs were just starting, and thematics have grown in popularity over the last few years. So I decided to break away from the big investment bank structure and start a company focusing on thematics, but with a concept that breaks traditional protocol in a way as it relates to indexes, because we work with industry thought leaders, people that are inside of the themes, people that are inside of the industries that we're targeting. So our first index was the Quincy 100, which focuses on the music, media, and entertainment industry globally, with a focus on streaming.
And so now you brought up Quincy Jones, and I hear that there's a very interesting story behind that one. So how did that relationship come to life?
Sure. So we first met with Quincy's financial advisor, ICONICBETA, in San Francisco. ICONIC's a big family office. They manage money of a lot of high-profile Silicon Valley entrepreneurs. And we discussed our concept with them of humanizing the stock market and getting theme-relevant icons to participate and exploring the themes and help us with developing the index concepts. And at the time, we were working with a number of sort of celebrity figures in the industry, but nothing really fit by way of sort of smarts and intelligence and their in-depth knowledge of the business. And ICONIC said, you must meet with Quincy Jones, and we did, and we met at his home in LA, and we didn't look back. Quincy's been in the business for over 70 years. We see him as a professor. He's touched every aspect of the music, media, and entertainment business. He's seen it from audio cassettes to streaming. He's 27 Grammys, 35 honorary doctorate degrees from Harvard and Princeton. You just do not get more authentic as it relates to input and credibility for that industry. He's been super valuable to us, and he knows the industry inside out. He was an early investor in Spotify, for example. And we went to Quincy and said, we're thinking about building this benchmark for the music, media, and entertainment business. PwC, UBS, Goldman Sachs, they publish research on this industry annually, yet a true benchmark didn't exist. And as we kind of got into deeper and longer dialogues with Quincy and his team, they've really encouraged us to switch our thinking more towards streaming and what streaming means for the industry. So we broke away from some of the traditional music, media, and entertainment companies like publishing, for example, or movie theaters. We got rid of those, and we really pushed the direction towards streaming.
And are you able to share names of any other celebrities that you're working with or looking to work with?
Yeah, I wouldn't say celebrity, because it's not so much celebrity, and I really do hate the term celebrity. Excuse me. It just
no.
Celebrity to me is something entirely different from who Quincy Jones is and the type of theme thought leaders that we're looking to work with. We're, rather than working with analysts behind a desk on Wall Street that have maybe focused on the fundamentals of the industry, we've got such a unique insight by going to the source. Like Quincy has opened up doors to people that we just wouldn't otherwise have access to really understand how artists are thinking about the industry, where artists see it going. We got a intimate insight into DJ Khaled and Nas and some of the other big stars and how they develop their careers thanks to social media, for example. DJ Khaled is one of the most famous DJs in the world now, and that sort of encouraged us to really look at how we were incorporating social media into the whole mix of music, media, and entertainment, and how the whole industry works together, and where they all saw it going. But so I mean, as we've worked with Quincy, I mean, we're looking to work with other iconic thought leaders across other themes that make sense. So, for example, I'll mention the sports industry. The sports industry, we've developed sort of phase one of that index, and it looks really good. That people are leading healthier lives around the globe. You've got a growing middle class and emerging markets that are leading healthier lives, that are working out more. People are being more health conscious now, and we found that that's having a knock-on impact on the stocks. So, and it's a theme that makes sense and connects with people. That's really important for us as a company. We want to create themes that are authentic, that connect with people, that your mother, your father, your sister, your brother will understand when you speak to them about it. I find, I grew up in the financial industry. I got into it when I was 23 years old, and one of the first things that I recognize is that we all speak in this language that not everybody can really relate to, and it creates this sort of mystical environment, and it makes people intimidated to participate in the public equity markets, for example. So we want to take a very tech approach in how we connect to people so that they can relate to our themes, they can understand what they're looking at, and develop a human story around it.
Of course, and absolutely, music is it's a language understood by all, right?
Yeah, no, absolutely.
Can't get any
I think,
easier than that.
Absolutely. We've spent a lot of time over the past year, doing focus groups with, college age Gen Zs all the way through to, young professionals that are around my age, early 30s, millennials, and, asking, well, what do you think of investing? How do you think about investing? A lot of people, a lot of more credible companies that have been around longer than us have done this as well, but we really got intimate with these groups of people, and what we found is that young people are having a huge impact on how their parents are investing now as well, which we found was very interesting. And that if you look at the 30 trillion wealth transfer that's going to happen from the boomers in the next decade, we really do need to think seriously about how we're connecting with the millennial and Gen Z generation.
Yeah, of course, absolutely. And so that was my question to you. So what are some of your uncommon approaches when discussing investments with the next generation to come?
Yeah, I think just look at connecting and speaking to people in an entirely different way than what the financial industry has previously done. Like Facebook recently did a study where they found that 92% of millennials don't trust the financial industry. That's a significant percentage of people who don't trust the financial industry. And the most trusted industry of all is technology. And technology has simplified. If you look at the technology behind your smartphone or any tech, the software is complex, but they've simplified. The way they communicate to people is done in such an authentic way. And I think the financial industry needs to follow suit. And by offering themes that, of course, make sense from an investment perspective, but taking it down different layers where you have a human story, you remove financial industry brands altogether, and you speak to people in a way that they can really relate to, and you offer themes that people believe in, and that they can have a conversation about. The S&P 500 or the FTSE or the Dow, very important benchmarks, very famous benchmarks, but there's only so far you can go in conversation about them. If we go back to the sort of streaming music, media, and entertainment theme, that touches our lives every single day, and is very much driven and evolving thanks to the millennial and Gen Z generation.
So then, is it safe to say that technology? Sorry, go on.
Yeah. Please carry on.
No, I was just going to say, is it safe to say that technology is one of your driving forces behind your approaches?
It is. I mean, when we first connected with Quincy and his team about over a year ago now, we were taking a very traditionalist approach to this, which quickly evolved to a very tech approach. About 47% of the Quincy 100 is in the technology sector. Technology is just driving the second digital revolution in music, media, and entertainment. And I say second digital revolution, but that's actually a term that Goldman Sachs coined for the music industry. So I'll give them credit for that term because I think it's brilliant. Music is going through the second digital revolution. It's really organized itself thanks to the subscription model. And companies like Spotify have really transformed things, cut out piracy, and are doing great things for the industry.
This is a complete unethical question, but given Quincy's age, how technologically advanced is he?
You would be surprised. You'd be shocked,
right?
actually. he is so incredibly advanced that, you know, it really does blow my mind. You know, he's really one of the most intelligent people I've ever met, and the most connected, well-read, current, you know, human beings on the planet. He's at the forefront of that whole industry. He keeps his finger on the pulse, and he's active in everything that's new and that's coming into his business. You know, there's nobody. You know, we say that he's really at the epicenter of it all, because people look at him as sort of a godfather figure for the industry. So, you know, whenever a new artist has a new idea or there's a new company coming to market, people go to Quincy Jones. They ask what he thinks. You know, he's a real, you know, thought leader sitting right in the center of it. You know, we've been so lucky to have his input from the beginning of this. We feel, you know, hugely privileged for that.
Oh, that's awesome. And so taking us back to the new millennials, you know, what are some of the different approaches that you would take in getting them to think long-term investing? Because you know, technology is changing so fast every day, but you know, and so is the market. Market and technology kind of go hand in hand, where, you know, it changes on a daily basis. But, you know, investment and investing should be in more of a long-term forecast. So do you have and I keep on saying the word approaches, because, you know, you're doing it so differently than what's the norm, that, you know, how are you getting in front of them? How are you looking at achieving those goals that you've set out with the new generation?
So it's really something that, you know, we've thought long and hard about and read in depth about too. You know, there was a recent interview with Larry Fink from BlackRock, where he's, you know, discussing long-termism and how long-termism is very important, but in a, you know, society now, short-termism is such a hot topic. You know, whether that's from, you know, streaming a song on demand, or, you know, buying the latest cryptocurrency on a credit card. You know, like short-term immediacy is something that we've all come to expect in our day-to-day lives. But when it comes to thinking about investing and long-term and saving for the future and, you know, pensions and retirement, it's pretty boring, dull conversation to have. So I think the most important thing here is that we have to shift that conversation to make it one that's interesting and exciting and relevant, and, you know, forces people to really think long term and into the future. And, you know, ETFs, where I'm not here to talk specifically about ETFs, but, you know, indexing and tools like ETFs in general offer a really good way for, you know, new investors or you know, current investors alike to think in that way. You know, TD Ameritrade did a study recently on, like, what do millennials invest in? What are the most popular stocks? You know, it's you know, your usual Amazon, Apple, Facebook, Tesla, Netflix, you know, Snapchat. I think I read a stat where 30% of Robinhood users bought, you know, the latest Snap IPO, and, you know, whether these stocks are good or not, they can be relatively volatile. You know, in a lot of our studies and focus groups that we've done, you know, one of the big questions is, you know, WTF is an ETF. You know, what's an ETF? So I think there's a lot of education that we can offer as a company, and that I think some of the bigger companies should be thinking about as well, is to, you know, a lot of people don't know what an ETF is. So I think we can take that conversation a step down, but in a way that's not dull and that's not boring. You know, let's take a leaf out of the technology sector's book and switch that conversation to one that is interesting and engaging and meaningful to people. But yeah, we're actually working with a company in San Francisco to develop, you know, our story as a company and how we, you know, promote our indexes, our current one and our future one. So we've got a lot of interesting ideas around how to do that, but we're definitely trying to break away from traditional protocol. Okay. I'm sure you'll see more from us. You'll see more from us in the coming months.
Oh, definitely, and we'd love to. Well, we're almost out of time, so my last question to you: what's next for you and ICONICBETA?
what's next for us in ICONICBETA? We have there's a lot of moving pieces right now. We're a very young company. We're operating with, traditional infrastructure. The bigger companies like Solactive, Exchange Traded Concepts, and some of the other bigger companies. But as a young company, we face a lot of sort of startup issues that maybe some of the other companies like Vanguard and BlackRock don't face on a day-to-day basis. And I think some of the bigger companies should really be supporting new entrants into the market, because it promotes evolution and things like that. But so what's for us is to just really push forward, get our story out, and ensure that the way that we communicate our indexes is the best that we can do it.
Of course, absolutely. Well, that's pretty much going to take up all of our time. Thank you again, Donna, for joining us today and sharing your insights. Thank you, Yasmin, Daya, and JP Morgan for supporting today's webinar. And thanks to you, our listeners, for taking time out of your busy day to think about these critical investment ideas with us. Join us again next week for what is the ETF of the year for 2017. Hear from the 6 nominees nominated for the ETF of the Year award, the 2017 award that will be taking place on March the 22nd. Thank you again, and see you all next week.